High risk, high return is finance's first lesson. But high-yield bonds may be the exception. After defaults and downgrades, their net return premium over investment-grade bonds nearly vanishes. We dissect the data, the mechanism, and the current risk in the BBB market. Every finance textbook tells you the same thing: to earn more, you must bear more risk. High-yield bonds, often called junk bonds, are the poster child for this trade-off. They offer higher coupons to compensate for a higher chance of default. But what if the compensation is not what it seems? What if the extra return is mostly an illusion, a statistical artifact that disappears once you account for the losses that actually occur? Let's start with the data. A comprehensive study by Edward Altman and his colleague, covering 5 decades from 1971 to 2020, provides the clearest picture. High-yield bonds delivered an average annual return of about 8.5%. But that headline number ignores the cost of defaults. The average annual default rate was 3.2%, and when defaults happen, investors recover only about 40% of face value on average. That means defaults shaved off roughly 1.9% of principal each year. Subtract that, and the net return drops to about 6.6%. Let's formalize the calculation. The net return is the gross return minus the expected loss from defaults. The expected loss is the default rate times 1 minus the recovery rate. With a default rate of 3.2% and a recovery rate of 40%, the expected loss is 1.92%. Subtract that from the 8.5% gross return, and you get about 6.6%. This is the return that actually lands in your pocket, on average, across the cycle. Now compare that net return to investment-grade bonds. Over the same period, investment-grade bonds returned about 6.2% annually. The difference is just 0.4 percentage points. But the volatility of high-yield bonds is 2 to 3 times higher. You are taking on double the price swings for a sliver of extra return. That is a terrible risk-adjusted trade-off. The Sharpe ratio, which measures return per unit of risk, is far worse for high yield than for investment grade. Here is the real kicker. The high yield does not come from the coupon, as you might think. It comes from price crashes when ratings are downgraded. When a BBB-rated bond, the lowest investment grade, gets cut to BB, the first junk grade, its price can drop 20% or more. The extra coupon you earned over the years is wiped out in a single downgrade. You were collecting pennies while the market was setting up a dollar loss. Let's quantify the downgrade risk. Suppose you own a BBB bond with a 2% higher coupon than a similar investment-grade bond. Over 5 years, you earn an extra 10% in cumulative coupon income. But if the bond is downgraded to BB, the price might fall by 20%. Your net loss is 10%, even before considering the default risk. The extra coupon is a small compensation for a large tail risk. Now, the current market is sitting on a powder keg. As of 2025 to 2026, the stock of BBB-rated bonds in the United States has surpassed $3 trillion. These are the fallen angels in waiting. If the economy slows and a wave of downgrades hits, these bonds will flood the high-yield market, driving prices down and yields up. The high-yield market could face severe selling pressure, and the high returns could turn into deep losses. Let's model the supply shock. If a fraction of the BBB market gets downgraded, the high-yield market could double or triple in size. The price impact depends on the elasticity of demand. With a fixed pool of buyers, an increase in supply forces prices down. The formula is simple: the change in price is proportional to the excess supply. A 10% downgrade of the BBB market would add $300 billion of supply, potentially overwhelming demand. This chart summarizes the risk-return trade-off. The left bars show net returns, high yield at 6.6%, investment grade at 6.2%. The right bars show volatility, indexed to investment grade at 100. High-yield volatility is at 250, meaning 2.5 times higher. The visual gap in returns is tiny, but the gap in risk is enormous. That is the statistical illusion in a single picture. So what should you do with this information? First, do not chase yield without understanding the risks. The extra coupon is not free money, it is compensation for a risk that may not be fairly priced. Second, consider the timing. With BBB bonds at record levels, the risk of a downgrade wave is elevated. Third, diversify across credit quality and maturities. Fourth, monitor rating agency actions and economic indicators. Finally, remember that historical averages hide the worst years. The average return is not the return you will get. The high yield in high-yield bonds is a statistical illusion. After accounting for defaults and downgrades, the net return premium over investment-grade bonds is negligible, while the volatility is double or triple. The current market, with over $3 trillion in BBB bonds, faces a significant downgrade risk. As an investor, you need to see through the illusion and demand a fair risk premium. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.